All right, welcome back. We're now doing chapter 15. We are all about bonds here today. I wanted to walk you through what a bond was. We're going to walk through some journal entries related to bonds, and we're talking about mortgages as well. But long-term debt, that's basically what we're talking about today. So I'm going to be flipping back and forth between some stuff on the slides, some stuff on the dry erase board. Follow through with me as we walk through. There are three things that you want to make sure that you have. Make sure that you have the PowerPoints that are available on Blackboard. Download the study guide as well. And then there's also going to be, for this chapter, there's going to be some Excel spreadsheets called bond schedules, which will be available out on the course materials area. So download those because we're going to go through those as well. So what is a bond? This is how a bond works. Bonds are basically long-term borrowings that bear interest. We're going to, as a corporation, we want to raise some money. So we could raise some through stock, which we did in chapter 13 and 14, or we could raise some through bonds. So here's a corporation desiring to raise some money. They have an issue date, and they're going to go out there and have some investors, some bondholders who want to acquire these corporations' bonds. So bondholders are going to send some money over to the corporation, and the corporation in exchange on the issue date is going to give them a bond. So what happens? What does a corporation have to do as a result of this bond? Well, periodically, every so often, they're going to have to pay some interest. The corporation at the end of the year or every 6 months is going to give some interest over to the bondholders. That's going to be some return for their investment. And then at the end, at maturity, the maturity is whenever the bonds basically run their course, the corporation is going to have to give the face value of the bond over to the bondholder at the end. Okay? So we're going to work through an example in the slides, and I have it up here on the board. If you flip over to the slide, we're basically walking you through a particular bond here. Here's a bond that a corporation issues. It's going to be a 10-year bond, and the face value is going to be $10,000. We want to walk through a couple terms here with you. There's a slide that talks about what face value is. Face value is the amount that we have right here that the corporation is going to have to pay the bondholder at maturity. So this is going to be stated in the bond agreement. The face value would be $10,000, meaning that at the end of 10 years, at the end of 20 semi-annual payments, semi-annual is 6 months right here, the corporation is going to have to give $10,000 over here as the face value there. We also want to talk about what the stated rate or the coupon rate is. The stated rate is basically based on the face value, how much interest is paid every year. Okay, so for this particular example, if we were trying to figure out what the stated rate here is, you got $400 paid every 6 months, semi-annually. So every dot that I have right here is 6 months period, should add up to 20 over the 10-year period. And so we're saying that $400 is paid here, $400 is paid right here. Okay, your stated rate is always an annual rate. And so what we're trying to do is we're going to figure out what the stated rate is, a little question mark right there. So if we looked and we said how much was actually received in interest for the full year right there, we'd have $800 that was received. It's always based on the face value. So $800 divided by 10,000 tells us that this particular bond was issued with a stated rate of 8%. A bondholder would be looking at this and they'd say, okay, I'm going to get $10,000 at the end of the term, 10 years from now, and every 6 months I'm going to get $400 because it's 8% per year. I'm going to divide that in half, and I'm going to have $400 each period there. We also want to talk about what the market rate is. So the stated rate is based on our bond agreement. So in our issue up there, there's going to be some agreement, some piece of paper that is going to be exchanged stating the face value and the stated rate. We're locking those in. We're going to be locking in all of these different payments during the period. But the market rate, if we went out there and we looked at other different investments, different bonds that are available, the market rate is what other similar bonds are paying for. So if we have a company that is a pretty stable company, we're going to look and we're going to say what interest rate are other stable companies paying. We're going to see in a minute, we're going to compare that to our different cash payments to see what our bond might be able to be traded for. Okay, and the bond ratings, we'll talk a little bit about this in the discussion forum. The bond rating is basically an independent appraisal of how likely the bond is to be repaid. Okay, if a company is a very risky company, they're going to have a lower rating. If they're a very stable company, they might get the gold standard, which is a AAA bond rating. Okay, the U.S. government for a long time had a AAA bond rating, and back in the summer of 2011, it went down to AA plus because there were some financial concerns that bond raters had. You're going to see this for different types of bonds, and you're going to see that the better your bond rating, what can you say about the interest rate? Well, you're going to be paying a lower interest rate. As your bond rating goes down, investors are going to require a higher interest rate in order to compensate them for the risk. Okay, so those are just a couple terms there to discuss with you. So let's look at this particular bond just one more time through the example. You can have it on the slides as well. 10-year bond, $10,000 face value paid at the end of 10 years. and $400 is paid every 6 months. And so the question comes up, how much would an individual investor pay for this? The very first thing we said, we're going to issue them at the start of the term. On this issue date, how much is a corporation going to raise in money? How much are they going to be able to sell this bond for? Are they going to be able to sell it for $10,000? Are they going to be able to sell it for more, or are they going to be able to sell it for less? Well, the answer is that we are going to be able to sell it for some amount depending on what the market rate is. So if you remember our present value topics, at the end of Accounting 211, we looked at how you present value. You figure out how much are all these future payments worth right now, okay? Well, that market rate is what we're going to be able to use in order to take all of our payments in the future. So you understand that this $10,000 face value is going to be paid 10 years from now. Well, if we're trying to figure out how much an individual person would pay for that $10,000 10 years from now, because of the time value of money and inflation and those type of things, they're not going to want to pay $10,000 right here. So what we're going to do when we have bonds, we're going to take our market rate. These are what similar bonds are trading for out there. We're going to take all of our cash flows, all the different 400 interest payments, so you got 20 of those along the way, and then you got your 10,000 face value at the end. Take all of those and discount them back using your present value, and then you got what the bond is going to be issued for. So on our financial calculators, hopefully you remember this a little bit, you can use your different notations. Your N is going to be the number of periods, and so we got 10 years, but they're semi-annual, so I'm going to convert that, and I'm going to put 20. My I is my market rate of interest, okay? So on our different problems, we're going to walk through a couple different examples where I give you different I's based different market rates. My payment is going to be what is being paid in interest every period. So my payment is 400. FV is the amount at the end, the future value of 10,000 there. And I'm going to be solving for present value, okay? Based on different interest rates there. So let's just go through our different examples. So in one of the slides I say, what price are bondholders willing to pay for the bond at the start of 2011 if the market rate of interest is 8%? Now we saw a minute ago that the stated rate was 8%, and we figured that out because we were paying 400 each 6-month period of time. That's 800 for a year, and so that was an 8% stated rate there. So if you take the market rate also was 8%, if we're putting it in our calculator, since we've converted to semi-annual, we're going to convert that 8% market rate to a semi-annual rate, and I'm going to put 4 right there. Okay, so that's 8% market rate divided by 2, and I got 4 there. If I put all this in my calculator, I should come up with a present value of $10,000. Someone would be interested in buying this particular bond for $10,000. And since this $10,000 that we're issuing for is the same as the face value, we say that that bond is issued at par. We issue it for exactly the face value. That means it's issued at par. Well, the reason why it's issued at par is this stated rate, remember it's 4% for the 6-month period of time, 8% for the annual, is the same as the stated rate. If your market rate equals your stated rate, well then your bond is going to be issued at par. What if we change that up? Okay. What if we'll come back to our journal entries here in just a minute. What if we change the market rate to 6? Okay. So now our bond is paying 8%. Okay. We're getting 4% every 6 months, but other bonds are paying 6% for the year, 3% every 6 months. So I'm going to change my I, and I'm going to put a 3 in there. 6 divided by 2 gives me 3. Now, for all these different payments along the way, I'm going to be discounting those at 3% every 6 months. I'm going to get a different present value, okay? Now, think about this with me. Since my stated rate is greater than my market rate, are people going to be wanting to buy for more or less? Well, I'm paying 4% per 6 months. Other bonds that are like mine are paying 3. So therefore, when they discount it back, we are going to have a premium here, okay? They're going to be desiring to pay more for our bond because we're giving them more than other competitors are giving them, okay? And so if we put this in the calculator, if I change it, the I to 3, you should come up with $11,487. That would be the present value of that particular bond if we discount it back, okay? Let's change that one more time. Let's change the market rate of interest to 10%, which on a semi-annual basis is going to be 5. Now our bond becomes less valuable. We are only paying 4% every 6 months. Other bonds are paying 5. And so instead of a premium, we are going to have to issue at a discount, okay? The stated rate is less than the market rate. Our bond is less valuable to investors out there, okay? So you should be able to put all these different numbers in there. And for this particular one, if you change that to 5, you should be able to come up with 8753. Okay, so these are the three different examples that we're working with on the bonds. We're going to go through one where we're issuing at par, one where we're issuing at a premium, and one where we're issuing at a discount, all because we're changing different market rates. Everything else is going to stay the same, and we'll go from there. Okay, so let's look at how we would actually journalize these. Go back to the one where we were issuing at par. Remember we said since the market rate of interest was 4% per 6 months, that we were going to be able to issue at par. We are going to get $10,000, which is the same amount as our face value. So how would I actually record this? Well, since we're getting cash of $10,000, I'm going to debit cash for 10, and the credit is going to go to bonds payable. This is a long-term liability, bonds payable. And since what we got was $10,000 and what we are going to have to pay back at the end was $10,000, I'm going to record the credit there to bonds payable for $10,000. This bonds payable account is always only going to be used for the par value. But in this particular case, we issued for par, so there's no excess that we need to record. We'll look at an excess when we do the premium and the discount in just a bit. So what happens with, as we go to our first 6-month period of time has passed, and now we are going to actually have to pay the interest right there. So now 6 months have passed, we're going to have to pay $400. That is interest that we have to pay because we've used that investment for that particular period of time. We're going to record it to interest expense, and we're going to pay cash of $400. Simple enough, okay? We still owe $10,000. We're going to pay that all the way at the end at face value. We would do an entry like this every 6-month period of time for those 10 years until we get to maturity, okay? Now we get to the very end, and we are going to have to pay the face value. So we get all the way to December 31st, 2020. Now the bonds payable is going to be paid off. So essentially we're just reversing our transaction from before when we issued debit bonds payable, which would reduce it for $10,000, and we're going to pay the $10,000 of cash as such. And then our bond is basically wiped off the books. We put it on at the issue, and then we took it off whenever we had the maturity. Okay, you can walk through with me on the amortization schedule. So if you look at our different files that are out there for the bond schedules, this is the very first one, walking through with you basically how you would record the different transactions and how your market value or your book value changes across time. So this 4% right here, remember we said based on a stated rate, we had 10,000 times 8% stated rate, that's $800 that we're going to be paying for the year. But we're going to do it semi-annually, so I divided that by 2, and I got my $400 payment right there. Okay, you should be able to follow everything on our schedule there. This is a fairly simple example since we issued it at par. Let's do the other example where the market rate of interest was 6%. Remember, we're paying 8%, 400 every 6 months. Other bonds are paying 6% for the year, 3% on a 6-month basis. And so on our schedule, we determined a minute ago that we're going to be able to issue this bond. When we present valued all the different payments, we're going to be able to issue it for $11,487.75. Okay, that's the present value of the bond. That's how you price the bond, is just figure out the present value of all your payments using the market rate. So flip over with me on the second schedule here. Here is the schedule for your premium. Okay, so what happens is, let's just look at whenever we issue. Okay, so we were able to sell this at a higher dollar value because we're paying more than the market. So cash is coming in of $11,487. Okay, and we'll just round off for the cents for now. You can follow them with the cents on the slides if you want. My bonds payable account, I said just a minute ago, my bonds payable is going to be credited for only the face value that I'm going to have to pay at the end. $10,000 is my credit there. Well, so I got a difference between my debits and credits. I got an issue here. So I need $1,487 more dollars of credit here in order to balance my entry out. But where does that go? Okay, since I issued it for more than my face value, I have a premium on bonds payable. Now this is an adjunct account that goes with our bonds payable. We're going to keep them separate, but on a balance sheet, these are going to go together. You'll basically see bonds payable. Right below it, you'll see premium on bonds payable, and they'll be added together. When you add them together, that's called your book value or your carrying value, okay? So that's what you see on my slide, and we'll put this up here on the screen, and you can maybe walk through us with this particular example here. So on our screen right here, I got my bond carrying value of $11,487. Now, if you looked at our chart here, remember we issued for $11,487. That was money that we got. What do we have to pay at the end? We only got to pay our face value back. So even though we issued it for more, at the end of 10 years, we're going to pay $10,000 there in face value. So what is this 1487? What does it really represent? Well, since we got more than we had to pay back, what this is really doing is offsetting our higher interest payments along the way. So even though we're paying $400 cash, that's not our true interest expense. Okay, our true interest expense is going to be all of these different payments together. So let me erase this journal entry here and just let's look at the cash flows related to my interest here. I got $400 per 6 months times 20 is $8,000 of interest payments that I am going to have to make. Okay, but I got more up front than I'm going to have to pay at the end, and I got $1,487 more up front. So what's going on really here is this is a reduction of my interest expense for the life of the bond. So if I just take my payments of interest and I subtract this premium here, 1,487, if you looked at our schedule here, I come up with 6,513. That's my true interest expense over the life of the bond. And so whenever I make my different entries along the way to pay my interest right here, I'm making a $400 payment, but that's not my true interest expense. What I need to do at the end of the life, all I got to do is pay back $10,000. And so that premium that I put in my account, let's just draw out our T accounts here. Here's my bonds payable. I put in $10,000 there. In my premium account, I put in 1,487 with a credit there. Okay? At the end of the 20 periods, after the end of 10 years, this needs to be zero because I'm going to just be paying back the $10,000 here. I want to be writing this down. I'm going to be making debits along the way to my different premium, and at the end of 10 years, that needs to be a zero right there. Okay, and so we're going to see how this actually works using our schedule here. So back on our schedule over here, here's my 11,487, and I have some little notes here for you to kind of see a little explanation in the particular cell. You can just mouse over the particular cell. And I say that I determine this based on the present value. I got my 10,000 face value and all my different interest payments. I discount those back using the market rate, and I came up with 11,487. That needs to be written down over the 10 years down to the 10,000 that you see right here. That's my final carrying value that I want. Okay. And so we can ask the question, well, what's my true interest expense? Well, it's not 400, because remember I said over here, we're paying 400, but part of that is really just returning that 1,487 that they overpaid initially. Okay, so our true interest expense is going to be less. So you can see on the yellow highlighted thing here, my interest expense is going to be determined by taking my bond carrying value and multiplying by the market rate of interest for that 6-month period of time. Okay, so if I take 11,487 and I multiply, you can see up there in my little cell, times 0.03, which is 3%, and that's half of the market rate of interest for the year, I got 34463. That is my true interest expense. So let's think about this. What is going to occur in our journal entry? I need to record that interest expense, 34463. I paid cash based on my stated rate. So this particular column right here is just 4% of the $10,000. That was based on the stated rate, so 400 there. Well, so I don't balance here, and the reason I don't balance, I need 5537. That is the amount that I'm going to write my premium balance down. Okay, so I'm going to say debit premium on bonds payable for 5537 there, and I'll do the similar entry like this. It's going to have different numbers between these two guys right here, but over those 20 different periods, if I continue to do this, if I make all these debits to premium on bonds payable, as the schedule will show you, then my premium account at the end of the period, at the end of the 10-year period, is going to be written down to zero. Okay, so you go through the similar process here. So if we go to the second period here and we look at 12/31/2011, still going to pay my 400. That doesn't change time after time after time. My interest expense does change. Why does that number change? Well, I'm using the same formula there, but I'm taking my new bond carrying value. So now that I made that amortization of my premium is down to 1,432. If you add that to the 10, I got 11,432 as my carrying value. That carrying value times that same 3% market rate of interest is 342.97. That is my new interest expense for that second 6-month period of time. So you can see as my carrying value is going down, so is my interest expense along the way. Okay, they're related because we're just multiplying those times 0.03. Okay, and if I continue to do this, if I do this type of a journal entry, period after period, based on my schedule, and I do it properly, well, then I should have zero left in my premium. I should have my $10,000 still sitting in the bonds payable account, and then when I get to the end at maturity, I'm going to just debit bonds payable for $10,000, and I credit cash for 10,000 and my bond is done. Okay? So the big difference between this and the par value was we had this premium account and we're writing it off over time using the effective interest method. There's more about that in the books and the PowerPoints there. Okay? So let's go to the one where we did the discount. Okay? If you flip to the very next slide, you have the discount version. And so now the market rate of interest was 10%. We're paying still 8%, so our bond becomes less value. Okay? So if I discounted all my different payments and I discounted them at 5% per 6 months, we calculated this a minute ago, 8753 is the amount that they are willing to pay for my particular bond. So let's go through the journal entry for the issue of this guy. I only got cash of 8753. My bonds payable, I'm going to put my face value in there of 10,000, and so I'm off. So $1,247 is my what? What would that be called? Well, it's not premium because we didn't issue it for more than the face value, but we issued it for less. So that is discount on bonds payable. Okay? And this is another account that kind of goes with your bonds. On the balance sheet, we're going to show our bonds payable. The discount has a debit balance, and so it's going to subtract, and they're going to be shown as the net book value or the net carrying value. You can see on our slide over here. 8753 is the carrying value. That's what you would see on the balance sheet. We're going to go through a similar process of recording our semi-annual payments, but let's just talk about the interest real quick. So I'm paying $400 every period. Okay, is that my true interest expense? Well, the answer is no. Remember, we had 8,000 total of interest payments that we're making along the way. But we borrowed 8753. I got to pay back more. I got to pay back 10,000. So that discount, that $1,247 there, is really more interest that I'm having to pay. Okay, so my true interest expense over the life is $9,247 right there. That would be what I want to record over those 20 different periods there. So let's look at our different schedule and see what we would need to record for the first 6-month period of time. We're going to go through the same process. Okay, so your bond carrying value, if we follow this slide here, bond carrying value times the market rate of interest. Remember, market rate of interest was 10, but we're doing 6 months, so we're going to times it by 0.05, and you got 437.69. Okay, so that is my true interest expense based on my carrying value. 437.69. I'm paying cash though of 400, and my extra credit, my 37.69 right there, I'm going to be amortizing that discount off. So discount on bonds payable is going to be credited. Think about my discount T account. I initially put it in there with a debit. And over time, on 20 different 6-month periods, I'm going to be making little bitty credits along the way. And at the end of the life, it's going to have 0 in the discount account. And my carrying value will be exactly the 10,000 face value at the end. Okay. If you want to go through the second period right here, my carrying value is now written down to 8791. I'm sorry, it's written up. We're marching to the 10,000 face value at the end. You always, on these schedules, are always going to end up with your face value at the end right there. So it's moving up. And the reason it's moving up is because my discount is going down, and the discount has an opposite effect on our carrying value. So now the carrying value is 8791 at the end of the first 6 months. And so for the second 6 months, how do I figure that out right there? I'm going to multiply my new carrying value times that 0.05 for the market rate of interest. My interest expense is going to be going up over time. And the reason why is because my carrying value is going up. Okay? If you do the schedule properly, you should come up with $10,000 as your ending carrying value. You shouldn't have anything left in your discount account at the end. Okay, so that's an example of issuing a bond at par, one at a premium, and one at a discount. If you can do these problems, you're half of the way there on our particular bond problems. Okay, flip over to page 4, which is our zero coupon bond. A zero coupon bond is basically where we got this. We got no interest payments along the way. So you could take this number right here, the same bond, 10 years, 10,000 face value, but instead of 400 paid semi-annually, we're not going to pay anything, 0. Okay. Now this bond could still have value, it does still have value, because someone is going to get $10,000 at the end of 10 years, but they're not getting all these dots. All these guys go away. Okay. So how much are they going to be willing to buy this particular bond for? How much are we going to be able to issue it for? Well, all we have in terms of our payments is just that future value, that face value of $10,000 there. I'm going to take that amount, discount it back, and that's going to be how much I'm able to issue that bond for. Okay, so in this particular example, I figured out that this was worth 4,631. Okay, that $10,000 if we discounted it back. So I could do an N of 20, an I need to look at my market rate of interest, and for this particular example, I had 8%. And on the one in the slides, I have an annual bond. And so let's just change that back to the 10 years right there. Instead of paying semi-annually, we'll just discount it using annual payments there. So I is going to be that 8% market rate of interest. The payment is going to be 0. I'm not paying anything along the way. And I put in my face value of $10,000 there. If I solve for present value, I should get that 4,631. So what would my journal entry be at issue? We're going to walk through those same things again. Cash, I get 4,631. Okay, that's how much I'm able to get. My bonds payable that I'm going to have to pay back eventually at the end of the 10 years is $10,000. That's my face value. And so I'm short. That's 5,369. Okay, and that is my discount. Okay, so a zero coupon bond is just a discount bond that has a big discount because I'm not paying any interest along the way. Okay, now we're going to have to, just like we did before, we're going to amortize that discount and recognize interest expense, because even though we're not paying something along the way, we really do have interest because we're going to have to pay back a lot more than what we initially borrowed. Okay, so along the way we're going to be debiting interest expense and not cash, but we're going to be crediting the discount on bonds payable account. The numbers are going to change. The numbers are going to do the same process based on the schedule. Okay, so our interest expense, just like we did before, my bond carrying value times the market rate of interest there. And since we're just doing an annual here, we'll just do times 0.08. Okay, as my bond carrying value approaches closer to 10, this is our goal that we need to write it to. As this goes up, so does my interest expense along the way because they're related. We're just taking that carrying value times 10%. Okay. Okay, on our mortgage. So if you buy a house, let's just do a quick example of a mortgage here. So if you buy a house, you typically don't pay all cash for it. That would be nice, but most people take out a mortgage. And so what happens is they get a house, and it could be for $500,000, and typically they finance it through a mortgage payable. Okay. And they're going to be gradually paying this down over a period of time, 30 years or 15 years or something like that. So we just want to look at a quick example of how you would record a mortgage and the interest along the way. Okay, so let's look at our example in the slides. A mortgage of $500,000 was taken out at 4.5% interest. Okay, one payment is made each year for 10 years. Well, in order to figure out this right here, I didn't give you in this particular example how much the payment would be on an annual basis. Now, typically you make your mortgage payments on a month, but for simplicity, we'll just do an annual payment here. I would need to figure this out based on the financial calculator. Okay, so if I put in a present value of 500,000, an N of 10, an I is my market rate of interest of 4.5. There's going to be no future value. I don't have to pay anything lump sum at the very end. And if I put all these in and I solve for payment, I should get my 63,189. Make sure you can do that on your calculator there. Okay, so that's my cash that I'm going to have to pay at the end of every period. So I did this initially whenever I bought the house. At the end of the first period, I'm going to have to pay cash of 63,189 and 41 cents. That's my cash that's going out. Well, what would I need to debit? Well, whenever you have a mortgage, every payment is part interest and part principal. Okay, so I need to figure out here, well, what part is interest expense, and anything above that is going to be able to write my mortgage payable down. I'm going to be able to pay back the principal, because over time this is going to go to zero. Okay, so in determining my interest expense, I'm going to take my 500,000, which I got on my schedule here. That's the amount borrowed. That's the amount that's outstanding for the full first year. I'm going to multiply that by my rate that's for my mortgage times 0.045. And if I do that, I got 22,500. That's a lot of interest for a year, right? So out of this 63,189, the very first $22,500 is going to be interest expense. The rest is going to go to the reduction of my principal. So 40,689 and 41 cents. I'm writing down my mortgage principal balance. You could do the same thing over and over again. What is my new mortgage payable at the end of the first year? You can look at your schedule here. You got 459,310. Okay, so I'm writing this down. Now that this balance is lower, I'm going to have less principal, or I'm sorry, I'm going to have less interest expense in the second year and then in the third year because my principal balance is going down and my interest is based on my principal. The way a mortgage works, you're going to pay more interest in the early years than you do in the later years there. Okay, so you can follow the schedule through there. You're going to be doing a similar entry like this every single period. Cash is always going to be credited for that amount, but the difference between your interest expense and your mortgage payable, those are going to change a little bit there. Okay, so we walk through the par, the premium, the discount, the zero coupon. We walk through a mortgage there. There's a couple other things that we want to just cover really quick. If you ever hear the term calling a bond, that basically means that a company is going to repay that bond early. Okay, so what could happen is market rate of interest could go down. They might be able to borrow cheaply. And so instead of being tied into all these different payments along the way, so let's say they initially borrowed at 5%. Okay, they're paying 5% interest along the way. And if we had $10,000 face value, that means they're paying $500 every year. Okay, so what if market rate of interest, something happened and it went down? Okay, so now they're able to borrow at 2%. Interest. Well, they might have a call provision in their bond agreement that allows them to come back in and repay early. So after 2 years, they might be able to call the bond and basically give that money back to the bondholder, and then that wipes the debt off the books. And so if you go through the different example for how you would do that, you need to eliminate the carrying value. So what we're going to do is we're going to take the bonds carrying value off the books. So we debit bonds payable. If there's a premium associated with it, we would be debiting premium as well. Okay. If there was a discount with it, we would be crediting the discount. Okay. We're going to record the cash paid. So those are going to be a couple items there. Cash is going to be based on, so typically there's a little premium with the call provision. So we might be able to say we call at 102. And basically that tells us we're going to have to call at 102% of the face value. So we would take that 10,000 times 1.02, and basically we would have to pay 10,200 in cash. Okay. Now, typically they aren't going to balance out. So typically our book value is not going to be the same amount that we had to pay there. So if we need more debit here, well, that's going to be a loss on bond redemption. Okay. If we needed a debit in order to balance there, we're going to debit loss on bond redemption. If we needed a credit, well, then we did good. Our book value was more in debt than what we had to pay, so that would be a gain on bond redemption there. There's an example of that both in the slides and in the study guide. Make sure you look at that. I'm going to leave it to you to look at the leases in terms of an operating lease and a capital lease. Just go through the slides for that. But go back through your Excel spreadsheets. Make sure you know how to do the par, the discount, the premium, and the mortgage. Those are the key problems that you want to make sure that you know. Okay, so we went through a lot of things fast. If you need to go back through and walk through with me piece by piece on doing the journal entries, on walking through the schedules, be sure to look at that, and we'll see you in the forum. Thanks.